Well, hello, folks. Welcome to another live stream. I have Tony Locantro there and ready to go. Just for a moment or two, we'll put the pre-show on just to allow people to catch up and check in. We've already got a good number on, and great to see everybody here. Very important conversation this evening. So many things to talk about. And as with all of these things, there's lots of different things whizzing around. But to talk about things not whizzing around, the dogs... There we go. The dogs are pretty much sound asleep. Actually, Meteor is doing a little bit of housekeeping, which is good, but Luna's sound asleep. So there you go. Both dogs there. And I don't know whether you had a chance to see my Easter greeting, but if you didn't, I got the dogs to do a bit more singing to the piano. So that was what I did for Easter. So hopefully some people quite liked that. Anyway, I'll just run this for another moment or so. And just to say that... we've got good number on, and good to see some new names as well as the old familiars. And, I think this is going to be an interesting game. I hope you've got your bingo cards out. I'm sure we'll be playing Locanto bingo before long, which is always great fun. And Crusted James says, one of the dogs is moving. Yes, it's just to show you that the dogs are, in fact... not stuffed, they are live. There you go, they are actually live. That's Meteor giving things a bit of a go. I brought them back from their walk a little while ago, so they're just sort of settling in. And everybody's waving at the doggies. That's very good. Very good. All right, well, we get on the show, I think, now. So I'll take the pre-show off, and then I'll run the intro, and then we'll get going. So stand by. Well, good evening. Welcome to this live stream event on the 19th of April 2022. Martin North from Digital Finance Analytics here. Great to have you on the show tonight. And thanks for taking some time out of your Tuesday to spend it with us. It's greatly appreciated. And just before I bring Tony in, I'll do what I always do, which is just to remind you that we don't provide specific financial or legal advice on this channel. We do moderate the chat. This is as at the 19th of April 2022 if you're watching in replay. If you'd like to ask a question, use that What the World to get my attention. That makes sure that your question gets into my queue so I see it. I do encourage you to share your thoughts and opinions as we go, but if you use that What the World, that's a good chance I'll see it. I don't necessarily follow all the other chat streams. And I've also enabled Super Chat, which allows you to get your question top of the queue or indeed make a contribution to what we're doing here. Would be appreciated either way. Okay, so with that, I'm now going to bring Tony Locantro in. Tony, are you there?
Yeah, pleasure to be here, Martin, and hello, viewers. I've been following some of your programs. The last one I was actually in Budapest following it, and I believe I donated in forint, which is pretty much a worthless currency. But anyway, you still got the donation. And I encourage people to donate because it's a worthy cause, Martin, and it's a great service you run.
Well, thank you, Tony. And I'll take it in whatever currency comes. I really am not proud, but it all helps just to cover some of the costs of what we do. We do this not because we're trying to make a profit, but because there are some really important things to talk about. And I think at the moment, I don't know what you think, but I don't think I've ever known the time when there are so many uncertainties milling around, locally, internationally, financially, and socially. It really is pretty much unprecedented, I think.
Oh, beyond unprecedented. I just believe what I'm seeing, what I'm reading, where people are. I just think the world is turning to shit. And when I was in Hungary, the only channel I had was CNN. And, you could just see coming from the US that this is the riskiest time to be alive in years, decades. We've just got a combination of everything that I think that's going to contribute to certainly a change in world order. And sadly, we've undergone the most massive debt binge in history. and asset prices are grossly overvalued across the board. And suddenly we've got inflation, we've got supply issues, interest rates are going to go up. And I think we're absolutely rooted now. And Australia's about to find out that you can't drive a car for 30 years without reverse. So it's happening everywhere, every market, every Fugazi. As I said, for many, many people, just to knock one off the bingo card, this is going to be being the equivalent of being sandpapered to death, Martin. And, recently we had the death of Shane Warne and Taylor Hawkins from the Foo Fighters. And both these celebrity deaths kind of got to me. And I think that we've had this period of jubilation, high-fiving, buying shit we don't need to impress people we don't like. And I think that's all about to end. And I've been saying it for some time. I think we're going to get back to the 70s where life was simple. And I just shudder to think what a recession is going to look like in relation to curbside cleanups with all the crap we've accumulated. And, it's taken me 50 years to learn that minimalism is the way to live. Steak, Shiraz, and sex. The three S's, they spark joy, not a flashy car or a mansion in East Kalgoorlie.
Absolutely. Yeah, and it is interesting. Some of us, myself included, have been through previous recessions and previous downturns. And in fact, I can remember quite clearly the 1970s and what the economic parameters were there. And I can remember things like the 3-day week and the strikes in the UK, all those things in the 1970s. But there are many, many people who've only ever lived in an environment when interest rates have come down rather than up. And when central banks have been dramatically stimulating the economy, and so stock markets have only been going up. Some of those universal truths aren't universal truths, right? They can, things can change quite quickly, and we can suddenly find that the assumptions we're making about the way the world works may be actually inappropriate.
Oh, absolutely. And I look at the speculative blow-off in the Sydney housing market in particular, which reminds me of the final throes of the NASDAQ. That was just absolute madness. And I see that in a lot of markets such as, crypto, NFTs, NFIs, anything ending in IUM, which is soon to shift to Imodium, sadly, for the over-leveraged. But it's just absolute market madness. And, I've watched The Big Short probably 36 times. As you can see, he was patient. He wasn't wrong, but every time there's a stupid house price sale, people come on and say, well, all you housing bears were wrong. But what I think, Martin and viewers, is that this latest speculative blow-off, as you'll see in my slideshow, has made things a hell of a lot worse. And I think this bubble is probably going to be the worst thing to happen to Australia. And it's scary, it really is scary shit. And I know that our audience are educated, but if you haven't sandbagged your finances, you might be too late.
Yeah, and it is worth, I think, underscoring a couple of things. Firstly, Australia has got the commodities buttress, right? So our economy, relative to perhaps other economies in other parts of the world, at one level may do a little better. And that's one of the reasons why our markets are doing quite well at the moment. In fact, they're nearly up to where they were before the correction earlier in the year. But on the other hand, if you think it through and think, well, who are the people who are buying our exports, our commodity exports? If the rest of the world starts going offline, as it were, and the latest growth expectations from the World Bank and from the IMF are that growth will be a lot shallower than expected previously, and what's going on with China would suggest that, well, you can't necessarily bank this commodity support mechanism into the future, right? I think that's something that we should probably think a little bit about. And I'll make one other point, Tony. It is quite scary to watch. This is the market expectation at the moment of the future implied yield curve, right? So it's more than 3% in 18 months. Bear in mind, we're pretty much at zero now. So the markets are saying interest rates are going up, mate, and they're going up quick, and they're going up a long way, which is actually, I think, another big deal. Going back to my point about the fact that a lot of people have never been in this environment. They've never been in an environment where interest rates have been on the acceleration. So pretty much wherever you look, things are falling off the log.
Yeah, I actually remember the exact moment I think it was about 2008, where I was putting out the rubbish. And I was saying to myself, shit, mortgages are going to hit 10%. And that's before the GFC. And that's when pundits were saying that the Australian market will remain resilient because of super fund inflows. It's just like saying in 1929 that stocks had reached a permanently high plateau, or in 1901 where they said everything that could have been invented has been invented. But, a mortgage was going to 10%. And I reiterate this, the average long-term mortgage rate up until COVID was about 9.41% mortgage repayments, and the average RBA cash rate was 6.5%. And everyone comes out and says, nah, they can't lift rates. The RBA is going to try and stop the bubble bursting in Australia. Well, they can't. And, once I get through my slides, you'll see why they can't. But, we haven't had any real economic hardship in relation to rates, but that's certainly coming. So, and it only feels like yesterday I was heading towards a 10% mortgage. And what got me to sell in 2014 was we had an interest-only loan, and I got the principal and interest reset letter. And I looked at my second mistake at the time, and I said, shit, we can't afford the mortgage. We have to sell. And I was expecting a massive queue. East Victoria Park in Perth was going off, stupid sales everywhere. Not one person showed up to the home open. And luckily, when I built the house, I built it for someone that would want to buy it. I put a spa bath in and some other cool features. And then we only needed to attract one buyer. But, to see my repayments go up around $2,000 a month was frightening. So I just think that this is going to be an absolute shit show. And it's going to go to every facet of society, into cars and what people own and what formerly people saw as value, because a lot of stuff that you buy is essentially worthless. So my heart's going to break once this all unravels, because unfortunately we're on that slippery slope now.
Yeah, and my sense is that the angle of that slope is increasing, and there are more people sort of scrabbling up the slope, trying to climb right against the gradient. And it is interesting looking very closely at my surveys at how many households are already up against it. We've actually already got nearly 1.5 million households who are actually struggling with their cash flow even now, with those rates really low, with mortgages. And we've got a whole bunch of other people who are in rent, whose rents are going up, and they're finding it really, really difficult to enable them to pay their rent. So wherever you look, we've already got stuff going off now, and rates haven't moved yet. They're still at 0.1%. So it's pretty scary just seeing some of those forward things. And the other point to make is, and it's interesting, the Reserve Bank made this point particularly in their most recent stability report, was there are people on fixed rate mortgages at 1.99% and 2% who will have to refinance, and already those fixed rates are up by 1 or 2%. And if you go from a 2% to 4%, that's equivalent to a 30% increase in your monthly repayments. That's a big number.
Yeah, I actually, in November last year, I fixed for 5 years at 2.64. That same interest rate now is over 4%. And my interest rate costs from then to now would have been 10 grand extra a year. And I don't know where families are going to be able to find that sort of money, and especially those that are coming off fixed loans, they're going to have to refinance. You cannot, the time to have your garage sale has passed. The peak in used cars has passed. Supply is going to come now. You can't sell your RAV4 for a 10 grand profit or your Land Cruiser for a 50 grand profit. And people realise, I'll sell my Ralph Lauren polo shirts. Well, they're worth $5 to $10, even though you paid $130 for them. The second-hand market is shot to shit. Good luck trying to sell a treadmill or a bar fridge or a chest freezer. It's sad. I don't know where people are going to generate the extra money. It's certainly not going to come from trading stuff. All the decent jobs, second jobs out there are already taken as well. I mean, you could apply for that many pizza delivery jobs or cleaning jobs, and people that actually want to put in the hard work have got those jobs. So I don't know where the extra money is going to come from. Buy now, pay later. People are using that as credit, as the figures would suggest. They're all bleeding money. Payday lenders, again, everyone is bleeding money. And the only positive I see coming out of this is the mother of all resets, where life gets back to basics and future economic students and aliens will have the biggest laugh at Australia and the rest of the world. So, yeah, no, this is scary shit. And this shit is real, people. It just got real, and now it's accelerating.
Absolutely. And it's interesting, Justin made the point, won't the government step in before it gets too high with some relief scheme? And of course, if you go back through the COVID cycle, interest rates were cut, then they did the various schemes and the support mechanisms, and through the election cycle, they've already said, well, we'll lift the ceiling on how much the government scheme can support. But there's a limit on how much the government can do if and when the property market really starts turning down. And unless they do another sort of really very strong move to provide the bank with really cheap funds again, which would cost an arm and a leg, they probably can't do as much as people think. So I always find it's quite interesting when people say, oh, no, the government's going to solve it, so it's not going to happen.
Well, that's complete bullshit, and people should know that. And, people now are getting $46 a week on JobKeeper, according to Morrison. The scary part is, Martin, I've got $1 million multi riding on Albanese winning the election. And the worst thing that happened to me was he opened up his mouth. So, it's a really sad state of affairs, but no government can bail out. What about the other years of OECD housing bubbles where you lose 70% of your gains? No government can bail out. Look what happened in the US. Look what happened to Ireland. Ireland's housing prices halved. We've had the mother of all speculative bubbles. It was a NASDAQ-style blow-off. No. If 2 to 3 people within a few streets want to sell, that real estate agent needs to eat first, and they'll use price discovery. And that's why you're starting to see some hideous price reductions and buyers are stepping back. There's no way on earth a real estate market at 17 times price to income can be protected. And I think speculators need to wear big boy pants now and not cry that a lot of these investors are simply greedy and they're not going to get bailed out, because I tell you what, the government and any organisation will not bail out anyone that loses money on the stock market. And in fact, people that choose the stock market over property are penalised in paying an absolute shitload of tax, especially on stocks they don't hold for 12 months. So there's got to be some equality here. And I think that we're going to get back to, grossly overvalued. Eventually, things will get to fair value, and then they overshoot to the downside. So, no, this government support, printing money, first buyer schemes, one absolute load of crap, because we're in the biggest building bubble yet. About 9 companies in Perth, builders, have gone under, and there's now graffiti on building sites where contractors and bricklayers aren't getting paid. So, this is beyond anything, and no one can help, not even the bank of mum and dad, because that's just another domino to fall.
Absolutely. What's interesting, CoreLogic's come out with their latest rental information for March, and there was a very strong upward movement. It was something like, I think, 8%. And so the very strong movement, 8.7% across Australia in the year to March. But one of the interesting things that they said, and again I did a show on this earlier on, was that the rental returns, the yield on rental properties only went up 1 basis point, and they're still languishing down as low as they have ever been. So even with everything that's going on, a lot of property investors are getting no real returns from their rental properties. And of course, with the capital growth already being very, very difficult to find for apartments, and now we're seeing prices begin to move back, a lot of property investors are also going to find it quite difficult. And it's interesting that the Irish analysis of what happened post-2008 was that, in fact, property investors were the first ones to hop out the market because they could. It was actually a lot of the owner-occupiers who got left holding the short straw because they needed somewhere to live. So it'll be very interesting to see what really happens with investors and whether investors react, as I think they may, with effectively limited returns and no capital growth. Well, why would I sell the whole property?
Well, exactly. You look at Melissa Caddick and Bernie Madoff. They were providing steady returns. Why would an investor go into a property for anything less than 6 or 7% gross yield? Why would you bother? Why would you go through all that pain, all those costs, all that documentation for anything less, than those figures? Because a great rental yield in the old days when markets were reasonably priced was about 10% rental yield gross. So I just think investors now, once you see capital gains start to erode, and they will, the investment market is going to get absolutely flooded. And then we might start to see some normalisation in the vacancy rates. I remember in 2006, I had to pay 6 months rent in advance and over the top to get my first mistake and my kids into a house in Perth. And I think that desperation is certainly going to return. So, markets are just totally out of kilter with any normality, and that extends from investment and rental, where people now are going to start getting desperate. They'll be living in cars, they'll be couch surfing. This is desperate times, and there's no easy fix.
No, absolutely right. And I will just mention at this point that Cookie Boy, who's on the chat, basically is supporting Asbestos Awareness Australia. That's the charity that I created for Jill after she died. And anybody who's on Twitter and retweets the information about this show, Cookie will actually make a contribution to Asbestos Awareness Australia. So if you haven't shared that earlier post, just nip across to Twitter. It won't take you a second, and just tweet that out so that effectively we can get a little bit more coming into asbestos awareness. It's greatly appreciated. It certainly helps us to do what we're trying to do with raising awareness of asbestos. Well, Tony, you put some slides together, and I think it would be good to spend a bit of time with those slides because they're always highly entertaining but also very thought-provoking. So do you want to go into the slides now?
Yeah. So there's the cover, obviously. Now, this is huge. This is the disclaimer. This is not tailored advice. It's general advice. And I know ASIC, there's a big thing now about flinfluencers. That's hard to say. But yes, I am a licensed advisor. I'm able to provide general advice, personal advice if I get to know you. And I did pass my financial advisor's exam, which I was very proud of because, to be honest, that was an absolute bitch of an exam, and 6 months of my life I'll never get back. So anyway, yeah, I've been in Hungary. I was there for 2.5 weeks, and it was due to a health scare of my future mother-in-law. And she came up with one of the best quotes I've ever heard, and that's my partner on the left. And I just found that hilarious that, finally her daughter's found someone. That's me. And now she'd be happy to die. And I think a lot of men would probably like to hear that. In a funny sort of way. But, interesting country, Hungary. I got to buy everyday items, fruit, vegetables, Coke, meats and that, but their cost of living isn't that far off ours. And that was absolutely frightening. I saw pistachios for what I thought was $2 a kilo. No, they're 20. And when I was dividing everything in Budapest by 252, I was absolutely astounded at how expensive it is for Hungarians to live, and their real estate for what you get is stupid expensive. Their price to income would be off the charts. And interestingly, we went to a fine dining restaurant called Spargo, and it was cost-wise, it was up there with Wildflower in Perth, which is Perth's best restaurant. And, it was fine, but I walked in, I was seated, and Aerosmith is playing. Then 3 songs later, it's Back in Black by AC/DC. Turns out not only were we in Hungary's most expensive restaurant, but they had an 80s DJ there as well. So anyway, so that's an example where in Eastern Europe, their cost of living is astronomical. They handled the refugee situation well. They were just tents around the city. Orban won the election. He's mates with Putin, and now Hungary's going to go through even more pain. But I think you've got to look at it. We have it fairly easy in Australia as opposed to Eastern Europe when it comes to cost of living and inflation. So if there's one takeaway from Budapest, that's it. That's how everyone parks in that city. Why would you buy a soccer mum SUV to have parking like that? But I think that is the place, sadly, where a lot of Australians find themselves, and there's just no way out with doing any damage. But that was one of my key takeaways from that trip. Now, I've put a median house price on Sydney of $860,000. Basically, on the right there, that's the Choose Your Own Adventure book. You can choose from 20 endings there. So I think people can put this into their calculations and say, well, what if Locantro is only half right? What is going to be the best ending out of these 20? So, I've done, it's been a bit of a guess. I've put every factor in. And the sad part is that if you look at an income base of $90,000, you're still up around 10 times, which is still far too expensive. And, Choose Your Own Adventure books, well, they were a bit of a classic because I used to deliver the Manly Daily when I was 10, 11 years old, and my spare change, I'd actually buy one of them. I love those books. But I think families now have the choice. What do they do? Do they sell up in Sydney? Do they find the last idiot? Do they buy 2 houses in Perth and have a good lifestyle? I mean, it's up to everyone how they do it. So Morgan Kelly, he is probably one of the most researched people on earth about housing bubbles. And this was in his debate with Jim Power, where he said house prices in Ireland would halve. And that's what he said. And I think if you look at the last $500,000 of the Sydney run-up, I think that's madness. And I would suggest that most of that is going to evaporate. Then you lose your 70%. And his research was based on every OECD housing bubble. He went into all of it. He was called a madman. Everyone said soft landing, the Irish economy is strong. They were talking about the construction booms, the number of people involved in construction. And there was a bit of a debt binge going on in Ireland. But I think the Australian situation now, we have far more debt. We have far more buy now, pay later debt. We have the frightening situation where the Bank of Mum and Dad is now the 9th largest financial institution in the country. And now we have David Koch in Sunday papers telling families to write contracts on personal loans. So I think it's going to get extremely nasty. And sadly, a lot of people in financial trouble will be waiting for people to die to get out of it. And you just don't want to see that side come in. So Morgan Kelly is well worth chasing up for his research. That YouTube clip, I think every potential home buyer should watch. So here's a bad sign. New Zealand is starting to slip away. The index down 7.8%. And I have a bit of a chuckle at fear of missing out to INPT. I'm not paying that. FOOP, fear of overpaying. FOBAT, fear of buying at the peak. And I think it's going to end up in an angel song that starts with, "Am I ever going to see your face again?" And credit to Doc Neeson. But, New Zealand lifted rates before we did. They had the balls to do it. Their market is cooling, but again, highly leveraged. And some of those prices in New Zealand are, absolutely crazy. So that's where I think that's heading. And sadly, New Zealand is going to lead us down. So we've got quality research and press such as the Daily Mail putting that out. We've got interest hike predictions from the banks. They're frightening. They're going to add, on the average New South Wales mortgage, up to 10 grand a year in interest, and I think that's only going to get worse. Terry McCrann, I think, makes a hell of a lot of sense. So food inflation, and that is evident everywhere you go now that the supply chains have loosened up. One thing, though, petrol has had a nice decline in price due to the removal of the excise. Now, this is the most frightening table I've ever seen in my life. I dragged that off Twitter. Not really, I think it speaks for itself. So if you look at those price to income ratios, the debt to income ratios, and just look down below where I've circled what interest rate increases will do and how it'll make up 71% of income. And that's just a massive spike with a 3% rise in the official interest rate, which sadly, I think that's where we're heading, because, this inflationary pressure has to be quashed now. The unemployment rate, according to Albanese, is around 4%. So if you look at the median prices, it's just so far out of whack. And this situation is, Australian families are going to be unable to cope with that increase. And that is absolutely frightening. And it might be worth a table revisiting in the replay. But I looked at that. My sister isn't really educated on housing markets, and I sent that to her, and she said, holy shit, watch out for this. But that says it all. So I look at some amusing house sales. Jordan Springs, which is part of East Alice Springs. Whoever sold that listed 13 days, probably got a bit over $1 million. I think a lot of the houses in that area all look the same with that brown brick frontage. It's like a South American bikini show where you can't really separate them until you can work out who can hold a conversation and isn't going to take all your money. Now we've got sea change, tree change gone wrong. Now people are now putting up desperate price reductions, some up to $500,000. And I think that's going to be quite an emerging trend now on the likes of Domain and realestate.com. And it just goes to show that I think these retreating prices are probably going to have the reverse effect, where buyers are going to step back as well. And, this work from home trend where people say, well, stuff it. I don't need to live near the CBD. Let's go rural and have paid overs. Then suddenly people will start to return to offices, because people, we're social beings. So I'd expect more reductions to come, unfortunately. And Box Hill, this is ridiculous. Someone sold that for that price. Box Hill, Rouse Hill, probably the epicenter of the housing bubble. And I'm going to give that. So you're about 50, 60 kilometres from the CBD or a beach. Now I'll look at Perth. Perth has the lowest median house price in Australia. So to me, that, all things being equal, even though there's probably more downside in Perth to come, to me, that's what a housing market should be, $655,000. For those unaware, that house is about 6 kilometres from the city. It's about 8 kilometres from a massive new shopping centre, and you're about 10 kilometres from the beach. And it's fantastic. And that's what people are able to buy in Perth for that sort of money. And if you look at that comparison, on the left, 6.6 kilometres to the CBD. I've done Box Hill to Manly. So to look at the ocean, you've got 57 kilometres, and you've got to go through all those areas. And one thing I don't understand is why people will torture themselves to buy out at East Alice Springs, East Kalgoorlie, to leverage themselves into assets that are going to halve in price. I don't know what people are thinking, but it's clear proof that money that believed the RBA, no interest rate rises to 2024, believed that we're in for a soft landing, has done that. And to me, that's worse than being sandpapered to death. That's fighting for your financial life. And again, I look at it, well, Perth is a functioning city. We have electricity. We have coffee. You can go to a cafe. We do have pubs. We have beaches. And there are jobs here, believe it or not. So, I don't know why people wouldn't take the lotto win and switch. But again, we all become Sydney Harbour huggers, where we think, the Harbour Bridge or the Opera House, and we need to stay there to waste our lives commuting and paying enormous tolls. So anyway, so be it. But that's the difference between a vastly overpriced market and a real estate market. Perth historically is still slightly overpriced, but is good value. And if ever a market ended, it was the guy that bought the first tweet from Jack, just setting up his Twitter. He paid $2.9 million for that. He then offered to sell it, or when he sold it, to donate up to $25 million to charity. And the last I looked, that the highest bid was $10,000. So anyway, I know that the Bored Ape Yacht Club have generated all this money for people trading Bored Apes. The younger generation will say, Locantro, you're a dinosaur. Buffett, you're a dinosaur. But, we'll look back at this time in history and think, really, what the hell were we thinking? And that even, goes back to .com stocks or the tulips. But at least you've got sometimes to take delivery of a frigging tulip. But, I mean, that's extending into other markets. And these days, you don't need to go on Married at First Sight to become a social media star. You just need to have a 7 out of 10 body or a little bit higher on the looks department and access to a basic charting package. And this has just gone absolutely nuts, where people in bikinis, porn stars, have been able to generate hundreds of thousands of followers and to sell this absolute rubbish on the youth and older investors who feel as though they've missed out. But all this does is get you to develop bad habits. And it's like once you become addicted to a sports bet app, it's addictive. And these apps are designed as such. Once you're on the punt, it's hard for you to turn your financial habits around. So, yeah, certainly those that have stayed out of it, probably questioning its validity or what the hell am I doing, I think in the long run will do well. But I don't think the buyer of that NFT is going to get anywhere near his 2.9 million. So again, that's another market where the bubble certainly has burst. So what I do, I'm into small cap stocks. So I have 20 companies that we will go in. We build large positions in these companies. The last one, Morona Metals, we took 15% of the entire company for mum and dads. So I tend to back the underdogs that in investment. The reason why I did this was it's the best value IPO I've ever seen that's in favour for shareholders. It's a base metals resource in Queensland, which has 100 million ounces of silver, and the enterprise value of the whole shebang is $15 million. And I know that if that silver resource can be extended, that much bigger companies will be snooping. But yeah, it's been an interesting ride. I deal with a number of setbacks. I had one today, Narada, who are looking at getting their cholesterol drug into the clinic. Their manufacturing is in Shanghai, so there's been a slight delay, and that gives people an excuse to sell. So, I cover a lot of biotech. We're in a global biotech bear market at the moment, and I liken some of these biotech stocks with the valuations similar to buying beachfront property 20 years ago. So that's pretty much what I do. What I want to make perfectly clear is that markets can correct from any level. You don't need the Dow at, the Dow might fall from 20,000. It might correct in a nasty fashion from there. The fact it's over 34,000, sure, it's overvalued. The Nasdaq's overvalued. The Australian market is overvalued. But what I've noticed in my 24-year career is that small companies always become big ones. So I'm not really going to focus on the stocks at the moment. I know there might be some questions that will come up, but what I've found is that developing good investment habits, being able to spot these companies early really pays off, even though at some point you might get cut in half through no fault of your own. So anyway, that's what I'm doing. And that's led to, I actually sent out an email. I had a client email me. He said, well, can you mentor my 17-year-old son? It kind of has blown up from there. And I'm proposing to write 2 courses. You can read the titles on the left and right. So what I'm trying to do is teach young adults good financial habits to give them just a real-world education along the lines of what you do, Martin, and it will be totally interactive. And the good thing is I only really want to be paid as much as a dodgy lawyer. So it's going to be really cost-effective, and that could become a bit of a side gig. But I just don't think there's real-world education, and I don't think that much financial smarts extends beyond this channel, to be honest. So, yeah, I'll teach people how I go about finding small companies that become bigger ones with the aim of, 5, 10, 20, 50, 100 times your money, with the expectation that at some point they'll halve. So anyway, that's only a proposal at the moment. I need to find the time to write it. So anyway, that's it. That's the end of my presentation.
Tony, thank you very much. And always very, very insightful and some huge messages there. Yeah. I just want to go back to that mortgage thing because I think it's really, really important. And it's interesting that Westpac came out with a thing today saying Australia's debt servicing ratio, right, where it is now is quite low, sort of December 21. But if you look at interest rates, if they go up 2, 3, 4%, you're starting to get rates that were actually where they were before the global financial crisis was the last time they were that high. And so their theory is that means there's a limit to how far the Reserve Bank can actually put rates up before things break, right? Now, I think you and I would both be of the view that there's limits to what the Reserve Bank can do, because they're sitting in an international environment where the Fed is going to be putting rates up dramatically. New Zealand's already put them up. The UK's put them up. Canada's put them up. So you can't, I think, argue that the Reserve Bank can just freely do what they want. They've got to take account of this broader situation. So I have a feeling that the rate movements up are going to be much more in line with your chart from earlier on than perhaps what some of the major banks are saying at the moment.
Yeah, I don't see how the RBA can escape this. They already looked stupid for not lifting at the last meeting, and it's now the case of how do we round it up? Do we go up to 0.25 or do we go 0.4 and get it to 0.5? But I think for Australia, what's happened in New Zealand is the leading indicator. There's been some suggestion that rates in the US, they might need a 0.75 hike. And that is absolutely frightening. And what is going to happen with that level of how much people are going to have to repay as a percentage of the total income? Pre-GFC, absolutely. But we need to get back to, guys, what are the RBA managing? Are they managing Sydney speculators or the Australian economy?
Good point.
And you can't manage both. You can't do it. They haven't helped people in Perth that bought 16 years ago that are still well underwater and probably couldn't sell their property. I don't know. We're part of Australia too. So I just think, maybe they'll hit us on Melbourne Cup Day when we're all full of piss trying to back the winner, which is sad. But, I don't think there's any way out of this. I've got 4.5 years of my 5-year loan to go. I'm going to sit down and start planning. Hey, I'm paying 2.64 now. What happens if I have to pay 6, which is highly likely? Or the other option is they lift too quickly, things turn to complete shit, and I'm back paying that in 5 years' time. Who knows it's anyone's guess, to be honest. If they lift rates in an orderly fashion and we do have the bubble deflates gently, then now that way we're probably going to end up in a more normalised interest rate environment, which means housing is still rooted. So I don't think anyone can win out of this except those that are sold at the top, have been able to find a rental or have moved in with their parents. So, it's just ugly to ugly.
I tend to agree. And, I've been looking at the sensitivity of households to interest rate rises, 1.5 million in mortgage stress. If rates went up by another 2%, that would be another 350,000 added to the bucket of people who would be in financial difficulty. If it went up 3%, then you're another nearly 500,000 households. I mean, these are big numbers. And, the economic impact on the broader economy of people struggling means they're going to spend less down the shops and all those sorts of things. So there's this economic consequence. So I'm of the view that the Reserve Bank will, they'll have to act, and they'll have to actually keep acting because they've got no other choice. But I also agree with you. There's a very severe risk that we ultimately create a crash through this. And it's interesting that there's a 35 to 40% probability now in the US from the markets of a crash next year. It's gone up quite dramatically because everyone's now saying, well, the Fed's going to have to put rates up, but when they do, it puts the cost of debt up for companies, it puts the cost of debt up to households, and I know in the US that there are more fixed rates, but that's still, debt is high, and people do have other sorts of debt too. The thing that people have forgotten in all of this is the cost of government debt will also go up, which means that effectively they're going to have to pay more taxpayer money to service the higher interest payments on the debt that they've created already. And that's something that people, again, haven't thought through in terms of the feedback loops here. So, whichever way you look at it, it seems to me that, interest rates are on the way up for a period of time, but they may well come back down eventually. But if they do, that's going to be crashing into a recession. And, you and I both believe, Tony, that in absolute sense, prices for property are at least 40% over where they should be in terms of any long-term measure of value. So there's always a risk they come back to that sort of situation. But then you make the point, but they'll tend to overshoot the fall before they come back. So, That's why that Irishman was dead right. There's a considerable risk of a very severe fall.
Yeah, and I think I see down the track the front page of the Daily Telegraph Mirror, which will be the daily, no longer the $1 million city. And that will dominate the front page. And I still remember clearly I was in Dublin 2010 for a Pearl Jam concert, and the front page of their newspapers were dominated with people in negative equity, teachers, nurses, emergency services people that couldn't move because they couldn't sell. They were in that dire financial position, and we're about to head into that as well. And if you're starting to fear lower prices, you're not going to go out and update your car. People will then stick with things that are perfectly fine. And you've got to look at the way Kia create their vehicles. They're very clever, because once you've got something with some whiz-bang futuristic gadget, they come out with another one. And people that have had money on their houses increase, they think, well, I need that new car. I need to go out and buy that boat. I need to buy all those clothes. For once in some people's lives, women will actually have to wear the same dress twice, sometimes within a month. So, labels, I think labels are just a sign that I have too much money, I'm stupid. Just buy clothes that fit you. You don't, get rid of all your crap, sell whatever you can. Life, as I said, it's all about the 3 S's and not being highly leveraged in debt, struggling how you're going to survive. But the wealth effect definitely is going to wear off. And suddenly we get back where you actually have to work for your money, and you have to think about what purchases you make. And that's it. And people now will say, well, it's good to be a bit of a minimalist, but let's face it, the new rich are those that are debt-free, that can move where they want and are not debt slaves, pretty much.
Absolutely. Well, this is interesting. Again, in my surveys, I find a lot of people who are now of the attitude that debt is just a permanent fixture in their lives. They don't ever expect to be out of debt. They'll take their debt to their grave. It is just part of, the way things are. And it's interesting how when I see some of the younger groups of people that I survey, some of those are getting quite twitchy about this idea of permanent debt. It's almost like, well, maybe that isn't the right way to go, right? Now, I'm of the view that there are times in your life when, a bit of debt to help you get into the property market might be the good thing, but it shouldn't be a permanent fixture. You shouldn't basically be living your life on the basis that the only way that you can make ends meet is to continually be in debt. That seems to me to be a marketer's dream, a consumer's dream, but actually it's not very sensible, particularly when the rates are rising as they clearly are now. So I think the mantra of saying, debt, are you sure? It is worth thinking about. And having specific strategies deliberately to reduce debt and to get out of debt. And it's interesting how very few financial advisors that I come across really know how to help people through that process. It seems to me a different way of thinking from the way that a lot of financial advisors would operate.
Oh, absolutely. And I think now that people are going to have to give solutions better than cutting and pasting old stuff. You really need to get into a family's financial situation. Maybe get rid of 3, 4, 5 streaming services. But if you look at it, that's only going to save, $100 a month. And now we're at the point where we've reached peak streaming. We've reached peak product. I mean, the most stressful thing in my life, to be honest, is being handed the bloody TV remote and saying, what the hell do you want to watch? And I think, it's immensely stressful. And luckily there are actually, I'll give this tip, Martin. There's a documentary on Binge called Gaming Wall Street, which is on GameStop and shareholder activism. And the other one is on Netflix, which is Trust No One, The Hunt for the Crypto King. So that's pretty much two docos worth watching. But people, once you start to cut that out of your life, you cut out Domino's, 3 pizzas delivered from $30. Even going back to home cooking is friggin' expensive as well. And you cannot escape it. You look at a decent cut of meat and you're up for $40, $50 a kilo. So I just think now we're at the point of no return where making a lot of financial changes is like trying to suck an ocean through a straw. It's just not going to have that impact. And now it's a case of financial advisors, then we're going to have financial counsellors, because unfortunately there's nothing we can do to avoid this. What I'm trying to instill in my kids is my daughter lives out near Richmond in Sydney, which is East Dubbo, and she's talking about buying a house. And I said, no, you're friggin' crazy. It's going to fall dramatically. If you really have to invest, come over to Perth. We'll wait for a bit of a correction and we'll get you started. You are not going to be able to afford that area, nor would you want to. But, financial advice really doesn't extend to that. It doesn't teach people that being an accumulator in life is better than being flashy, because it's a lot of the successful people have only 30 items of clothing, so they don't have to think about what to wear. They don't drive around in soccer mum SUVs and sports cars with Rolex watches and with the latest gold digger on their arms. So, as I'm trying to make clear, life is going to start getting to basics, but it's going to take the mother of all deleveraging to get there.
Absolutely. And just extending the life of the mortgage to 50 years, like they're doing in Japan, is not solving it, right? That's just pushing the problem on. So that's why this is an important conversation. But I've been speaking to a number of financial counsellors over the last few months, just getting a sense of how they're seeing it. And they're saying basically 2 things. One is the level of people's financial acumen is extremely low. So a lot of people don't know quite the trouble they're in. And secondly, they have no idea what to do, how to get out of it, right? Other than actually grabbing more debt, or buy now, pay later, or more credit cards, or pull down on the mortgage again, right? So that has become the default behavior. And trying to actually turn that around and get people to think differently, they say it really is a struggle because people are so wired into this way of thinking, right? And then they refer quite often to, that's the way that the marketeers work. Look at all the TV ads, look at all the ads in the papers, all of this, got to have it now, instant gratification. It's a whole philosophy, a consumer-driven society that is actually driving value towards those large organizations, but actually in the process creating a bunch of debt prisoners. So they're really saying, got to find a different way.
Yeah, well, if it's free, you are the product. And that's evident in that documentary on Robinhood and GameStop, where people are getting free brokerage, but there's a massive catch. And it's just funny how we've had the biggest debt binge, the biggest rush for buy now, pay later at the top of the consumerism cycle. It's frightening. And, we can put up charts, we can look at median prices everywhere, but it all gets down to how this situation is handled by the family, how they're going to make money. Do they need to take out second jobs? Do they need to refinance? And speculative markets can go dead quiet.
Yep.
Between .com and the uranium bubble, there was about 4 years of nothingness, and you had to actually invest in fundamentals and quality. Now, you just trade and hope to make money. But again, bad financial habits. So, a world of pain is coming. The warnings have been there. So, look out.
Yeah, absolutely. Now, there's a bunch of questions I'd like to throw at you from the chat, but this one from Stripey Cat comes up first, which is ScoMo recently announced the 2% government-backed home loan deposit for first-home buyers. And, of course, they've lifted the ceiling around the country, including in Perth. So the question from Stripey is, do you think this is going to actually inflate housing prices further or accelerate the fall? And any thoughts on time frames? So get your reaction first, Tony, in terms of what ScoMo said and did, and what do you think about it?
Oh, look, it's like putting a Band-Aid on a shotgun blast. Let's be honest, it's bolted. The horse is bolted now. I just think that it's just going to eventually accentuate the falls. There's plenty of supply around. I don't see a rush of first home buyers. Those price caps are beyond ridiculous. We can open up to immigrants. We can get people from other countries, but they're not going to be the ones going out and buying $1 million properties. They'll go conservative. They'll live conservatively. They'll probably have 2 to 3 jobs, and they'll work their backsides off. So I just think that that's a hope to win votes, but he doesn't have to. All Albo has to do is speak, and Morrison's doing well off that.
Absolutely. And just, strategically speaking, any of those incentive schemes tend to lift prices in the short term. It's pretty much demonstrated. Of course, what's happened with the previous schemes and the home builder scheme was you ended with this bottleneck of everybody sort of piling in. Then they can't get builders, they can't get products. The price that they've contracted to is not as big as the real cost now, because the costs have gone through the roof. So people are already trapped. And when you're buying at the top of the market, which is what people are now doing, right, with 2% equity, what that basically means is you only need prices to move a little, and then you're in negative equity. And the way these things work, you've got a guarantee from the government between 80 and 97% or whatever it is, 98%. But if things go down, the guarantee is not for that individual. The guarantee is for the lender, right? Yep. And this is what I don't think people have understood. You are still on the hook for the negative equity, right? Yep. So basically what you're doing is you're pulling people in at the top of the market and basically saying, go on, buy, it'll be fine. When, of course, what we're suggesting is prices are going to slide. So you go into the market now, you stick in negative equity. And in the UK, for example, when prices dropped 35 to 40% after the global financial crisis, there are still people now in negative equity, even now, which means they can't move. They're stuck in a property that maybe isn't the right property. They can't refinance because no one will refinance them onto a different lower rate because the negative equity exists. So you get locked in. And I don't think anybody is explaining the consequences to prospective buyers of these schemes. And again, it goes back to not good advice being offered by mortgage brokers or anybody else, frankly. It's a Ponzi scheme designed purely and simply to continue to stoke the construction sector. So it's not really about helping people come into the property market. What it is doing, of course, is giving a nice glowing ambience around their campaign, because they can say, well, we're doing this to help first-time buyers, but you've got to look below the waterline and see what's really going on. So for me, this is another classic example of a dumb strategy, a dumb policy in terms of housing and affordability, but it's probably reasonable politics, unfortunately.
Yeah, no, I agree. And it will eventually just exacerbate the falls which are coming and destroy people's lives in this belief that you should own your own home, because Morrison came out, if you can't find somewhere to rent, buy a place. But anyone with enough financial literacy and acumen certainly wouldn't be a politician.
That's true. That's true. Now, this is another one from Jason, which is, in your opinion, isn't being in debt similar to being owned by the man? In other words, you're controlled. Your life is not your own. I think that's a really important point, right? Because effectively, you have to play the game. If you're in debt, you are required to continue to play the game, which is to earn money to service the debt, to earn money to service the debt.
Exactly. And, you're an ongoing slave, and then suddenly, if your situation gets precarious, you can't move. But the way I look at it is, if you're renting, you've got to look at how much will it cost you to have a place to live. If that number's $500 to $700 a week, fair enough. Then you do your sums, as opposed to locking in a mortgage or remaining a renter. A lot of baby boomers that have sat on their backsides. Admittedly, they worked hard to get the houses and they've made all this money through inertia, and they now have the option to cash in their tickets. But I don't think many of them will, because they claim emotional attachment to a house. And really, something only has sentimental value if you can afford to hang on to the bloody thing.
Exactly right. And, it comes back to a fundamental question about what is housing for in the first place, right? So, in the good old days, housing was predominantly somewhere to provide shelter and a family and, your own cave that you can control. It's funny how now it's an investment, right? And everybody talks about, I get into property because I want to be able to actually see my capital grow, right? And it's like, by accident, I can live there at the same time. That, to me, is part of this sort of really weird thing that's gone on, where effectively property is now seen just as an asset class along like stocks and shares and bonds and everything else. The financialization, of course, is what it's called. But there are some very strong limitations with that. And basically what it means is that, people will then only be able to compete as an investment if you're actually investment class. And a lot of people aren't, and therefore they can't get into property in the first place. And that's another problem.
Well, I go back and look at it pre-COVID. I was on track to win that bet with Kukulis. The falls on that index were indicating that we'd drop that amount. Then suddenly COVID came along, and people think that property is a sure thing. They can use Fugazi equity to buy another place. I think it's just madness. And I always discuss with my partner the heat map. How much of a house, as per a heat map, do you actually use? And I bought, I believe, a place where 95 to 98% of our house will be used. And then you've got people like Mark Wahlberg or other celebrities that need 15 bedrooms, 26 bathrooms with a bowling alley, tennis court, squash court, sauna. That's all a crock of shit. And I laugh at these people that are so rich, they have to do what other rich people do. And who the hell's going to clean 26 bathrooms? And if I want to go 10-pin bowling, I'll get in the car and go to Morley. And, what the hell? And I just think we've been accustomed to building big houses, and the cost per wow, CPW I call it, is gone through the roof. I look at people that buy a $100 million house, and if 100 people come in and say, wow, that cost per wow is $1 million. And people will fall for entertainer's delight when you've got no friggin' friends anyway, and you couldn't afford the 20 cuts of meat to put on the barbecue. I just think we're sold all this crap. And, real estate agents are getting creative with close to schools. Yeah, well, everything's close to a school, close to a cafe. Get your coffee from McDonald's, for Christ's sake. But I just laugh at how the rich seem to think that they've got lots of money. They need to spend it in stupid fashion and buy these liquid assets that really just make you look like a tool. No, sorry, that's the way I feel, Martin.
Yeah, no, absolutely. Well, it's interesting. And Crossed It Jones said, it's time to get depressed. Can we name 2 positive things with the market before bedtime?
Well, I think, look, if you're in a sound financial position, I think you've got a chance to give people a great education. I always run with the mantra that there is always small companies and investment opportunities that become much bigger ones. Housing outside of Sydney and Melbourne, that's reasonable value, is going to become even better value. But we need the mother of all corrections, which is going to be a deleveraging event that's going to unfortunately take a lot of people down, and there's nothing we can do about it. A lot of viewers are probably well protected in silver, gold, precious metals, platinum. They are looking for alternative investments, or they're sitting on a heap of cash spread out amongst financial institutions. So I think the good news will come, but we've got to go through a hell of a lot of pain first and then we become a society less focused on consumerism, and this period will be studied for many years to come. So, look, it's not all bad news if you position yourself right and just haven't fallen for the bullshit that you must pay this, you must buy this, you must do that to impress people. So I don't think it's all doom and gloom, but we're going to cop it. And one aspect we haven't discussed is social unrest and having these new suburbs turn into ghettos, where you'll start to see it where people run out of money to have their gardener once a fortnight. And we're going to see crime, we're going to see drugs, you're going to see Nang use will probably blow as well. And, so we haven't even addressed social unrest yet. So things, have been pretty calm in Australia. But once we start to see the debt issues, the homelessness issues, the negative equity, the lack of decent jobs, it could all turn to shit.
Yeah, well, there's certainly a correlation between financial stress, societal stress, and violence and crime. Those things follow. And I did some analysis some weeks and months ago now, looking at mortgage stress and looking at mapping it onto the crime statistics, and specifically looking at some of the violence-related crime. And there's a very strong correlation, unfortunately. So, take Mandurah, for example, my Western Australian case study, right? There was a very significant issue with prices, and there was also a lot of social issues in that area too. So I'm afraid that's a strong correlation. Just going back to positive, there is one silver lining. For those who actually have savings and perhaps have savings in the bank, they might start getting a little bit more in the way of interest on their deposits. Not a lot, I suspect, because the banks will be trying to actually squeeze the margins to be able to make their profitability. But there might be a little bit of upside there, at least for some. And I guess, Tony, the other question which I want to turn to before we enter that is the markets, right? So the financial markets, and particularly the stock markets, because the Australian markets went down. It's sort of almost back to where it is now. The US is still a little bit down from where it was, but significantly up from where it was. I guess the question is, do you think the markets have really got hold of what this interest rate trajectory is going to do to the markets, or do you think they're still living in fairyland?
Definitely in fairyland. I don't think it's factored in at all. People might say, well, okay, there's talk the Fed might push it up 0.75, and they think, but the Dow's 34.4. No, it hasn't been factored in yet, and I think that these fast rate interest rate rises will see negative sentiment return. I think all the major indices are overpriced. It is going to correct. I think a decent correction is 20%. I think it can go lower. There are ways that you can protect yourself against that. Talk to your financial advisor about it. But I've certainly put a lot of my money into protecting myself against falling indices. So I just think that the market has tiptoed through the tulips for far too long and is due for a correction. And we saw what happened to the Australian market during the GFC. I mean, banks had to raise money at stupid cheap levels, and our major indices were almost cut in half. So I just think that, the risk for people going short, apart from unlimited losses if you try and short a company, is the fact that could Australia be seen as a safe haven? Could we have a massive flow similar to Scandinavian countries, Mexico, or others that have undergone that bubble? But my money would be on saying that, no, we're going to go through a heap of pain. And then once we start to get off the canvas, where do we go to from then? But I think most markets are way overpriced. People holding these stocks are in la-la land. I don't think earnings are going to justify the valuations at all. So there's pain all around. But, a lot of people now are gambling on day trading and anything with the pulse, the Bored Ape Club, NFTs, NFIs, and anything that shows that it can make money. But I think the market, people will then start to go to underground casinos. People will start buying Boys Town lottery tickets in the hope to get themselves out of financial despair. So, tough times ahead. But, as you mentioned, savers might see an interest rate on their account with a 1 in front of it. I remember going into a bank in about 1990, 91, and I was getting about 16% on a term deposit. And, that's a big return. And again, people that are investing a lot of money, leveraging into property, would want to see at least 6 to 7% return and not 1 to 2. So, look, there's going to be ways certainly to make money out of all this. There'll be plenty of scams, but I guess it's every man for himself, because there's no friends when it comes to money, Martin, and that if people can take that away, then certainly been worth their time tonight.
Yeah, and it's interesting. Vanessa just picked up your point about, is Australia a safe haven? It's very interesting. I was talking with Edwin just last night. There was a survey done in China about which country people in China were thinking about in terms of moving to. And it's interesting how Australia is now right at the top of the list again, because we are seen as a relatively safe haven compared with most of what's going on in Europe or the US or elsewhere, which is quite interesting. And if you put that on the table, and then if you put the commodities boom on the table too, there are a few reasons why maybe Australia will be a little better off relatively than other countries. But that doesn't mean we're not going to get a correction. That doesn't mean things are going to continue the way they are. It just means it might be a little less noisy than in some other places, right? So it's all relative. But I think it is quite interesting. And, there are some factors about Australia and where we are positioned, globally, and our resources and everything else, which suggests that there will be perhaps at least less issues here compared with elsewhere, but it's all relative.
Yeah, I think if you've I've done quite a lot of travelling, and this is the best country on earth, I believe, to live in. I've seen a lot of Sydney, as people know. I was a police officer in Sydney for 8 years. I was also briefly a police officer in Queensland as well. So I got to learn about areas of Sydney. I got to learn about human psychology, but I just cannot handle that level of congestion, the prices people have been forced to pay. A lot of outer Melbourne suburbs, people have bought land on their credit cards and are probably going to struggle to put a decent house on it, and there's no infrastructure. So for me, I was able to let go of my police badge. I was able to let go of the fact I would no longer live in Sydney, and I now live in arguably the most affordable capital city in Australia that has cafe and reasonable running electricity. I will say one thing, Martin, that our climate in Perth's been far too good, and I'm just wondering when we're going to cop it.
Yeah.
So,
yeah. Well, you're probably due a couple of cyclones coming off out from over that way at some point, right? But it's interesting. We've got a massive storm going on here at the moment. You may be able to hear it in the background. Huge amounts of rain and wind and things, and lots of crashes. So I'm not quite sure what's going on outside, but we've definitely got some weather locally at the moment. Interesting. Now, Cookie Boy asked this question, what do you think rates will peak at? Very hard to tell. I think I probably made the point earlier on that a lot of the major banks are saying that it won't be above 2%. My own view is that's probably not enough. It's probably going to be closer to 3, or maybe even 3 and a bit. I'm not sure whether the markets are totally right, but it's really hard to tell, isn't it, how precisely these interest rate rises are going to play out?
Absolutely. And, people say, well, the RBA average cash rate for a long time, 6.5. God knows what that would do. I can't see people being able to pay 9% interest on their house. But, can these rises that are done thoughtfully adequately tame inflation and bring the economy somewhat back into equilibrium? So, I think we've got to be a chance at having a 3 in front of it. So, and you look at the RBA, who sets the monetary policy and they were saying no rate rises to 2024. It's a bit like that. No Australian child will be living in poverty by 1990. And, Clive Palmer's claim that he can keep mortgage repayments below 3% for 5 years. I mean, that's just as stupid. So there's three quotes, and, I just think that, yes, rates are going to go up, but what is going to be the gauge? Do they stop lifting once prices Sydney get to 1.2 million, or Melbourne more reasonable? But we've got all these bottlenecks with supply. We've got massive inflation, food prices. We've got building shortages. So at what level did the RBA say enough's enough? And why can't the world go back to a normal interest rate environment eventually, which is a lot higher than here? So, I'm tempted to say, sadly, maybe a 3 in front of it.
Yeah, well, there are lots of uncertainties, and I guess we've got to also overlay the Ukraine situation. If things go worse there, the fact of the matter is that generally, wide conflicts create huge uncertainties, but also a lot of inflation, and that's something else to factor into the mix. Let's hope we don't go down that route, but there's a level of uncertainty that is there. But what we can say, of course, is that the cost of oil is very high. The Brent and the WTI is well above 100 again, and that's having a flow-on effect in terms of cost of fuel, etc., etc. So you can almost say, as we said at the start of the show, all of these various elements are moving. It's like sort of so many moving parts. It's almost impossible to nail precisely them all together to say it's going to be like this. So all you can do is to say it could be like that, it could be like this, it could be like that. And I guess this question here from Vincent, which is when does the current commodity cycle come to an end, is an interesting question. But that is so dependent on what happens to the Ukraine and the oil, and Russian oil in particular. What happens to China? Whether it actually has a soft landing or a hard landing, or whether the property sector in China falls apart. Clearly, we're quite fortunate in terms of the LNG that we have here and we can ship overseas is going to be in strong demand for quite some time. But you've got to argue, I think, that maybe the demand for some of the minerals will tailor off. So I think it's very hard to make a real educated guess. It's interesting that the latest Treasury modelling is down forecasting the price of most of the resources. So they're basically assuming in their modelling that the resource boom is pretty much going to come off its tops. And of course, that gives them a little bit of a nest egg if it goes on for longer. But the chance of it continuing like it's been going is probably quite low, I suspect.
Oh, absolutely. And you look at what happened in the nickel market, where that short seller got blown to smithereens. They had to then limit the trading ranges in nickel. You've got zinc, not far off an all-time high, but who really invests in zinc? And we look at the other commodities. You look at the lithium stocks in Australia, which have gone absolutely ape shit, that are capped at billions of dollars, that will only ever produce brokerage and broken dreams. So everything is just out of kilter. Prior to the GFC, we had calls of commodity super cycles, stronger for longer. Then we had lower for longer with interest rates. So who knows? Who knows what's going to be the next bandwagon where everyone makes money? It's just an absolutely bizarre time to be following financial markets. And sadly, what's happening over in the Ukraine, even though I felt perfectly safe in Hungary, that country is just getting absolutely bombarded. And I think it's, the inefficiency of the Russian forces that are just going to prolong it. And then you've got Zelensky saying, we could fight for 10 years. Well, what's that going to do to the world in terms of inflation, in terms of interest rates for the next decade? So, holy shit, there's just so many ugly things around at the moment, financially, socially, politically, and every which way. I just haven't seen anything like it in my lifetime, nor would I expect it. And who would have forecast a global pandemic on top of all that? So,
yep.
geez.
Absolutely. Well, if you'd written the script for a movie, the movie makers will say, "Oh no, that's stupid. It'll never happen. You will never get that coincidence of bad events all happening at the same time, right?" And yet, here we are in the middle of it. And I just want to reflect now, finally, in the last 5 minutes, because last time you mentioned a very interesting film about Don't Look Up.
Yep.
And I actually watched that again the other day. And I have to say, the second or the third time of watching it, I watched it right through to the end. You must watch it right through to the end to get the full story. But there were some very interesting things in there which really hit home with me about what's happening at the moment, which is the sort of the half-truths and spin that the media is actually spinning, the half-truths that the politicians are spinning, right, for their own agendas. And it seems to me that as well as all these uncertainties, we've got all these half-truths spinning around as well, which means it's very hard for people to get a real strong read on where things really are relative to where people are positioning them to be. Because, of course, going to an election, you don't want to down-talk the economy. You don't want to talk about the risks in the system, et cetera, et cetera. So I guess one of the questions I wanted to throw back at you, Tony, was, Don't Look Up basically said, just ignore it, right? If you do look up, which is what we've been doing today, you start seeing some of this stuff. I guess my question to you is, how many people do you think don't look up?
Oh, God. Probably 99%, Martin, that are more focused on reality TV shows, what they're streaming, debating whether Will Smith's slap was genuine or not, their poor start to the footy tipping season, which I think we've all gone through. I just don't think people can fathom that there might actually be some economic hardship and social unrest coming up where there's been a global pandemic. And who would have thought that my best savings plan was booking every concert in advance, whereas I've got every cent back so far and I haven't had to pay bank fees. So, I mean, who would have thought that the world, we are in this situation where I know in Hungary they don't wear, I'd say 5% wear masks. And I got to the check-in counter and they said, you need a rat test. And I had a sore throat. And I was shitting myself on that rat test because I was in a capital city where catching COVID was quite easy. But, I mean, this thing's going to go on. There's going to be variants. You look at what we've had to put up with here in WA. My mum's nursing home, pretty much everyone's got it now, and they've actually got the Defence Force in to help. So who would have thought? So, big money's made on betting with something that's not expected to happen. So, interesting times to say the least.
And in fact, Electrified said people are actively looking down, digging a hole in the sand and sticking their head in it. And actually, I think you could say that there are a lot of people who really are just it's too hard, it's too difficult, so we'll just carry on with the things that we do, and hopefully it'll turn out all right. She'll be right. And there is the Australian she'll be right attitude, which I come up against all the time. But on the other hand, my belief, and I guess your belief, is, Tony, that if you do actually look up and if you do actually begin to think about some of these things, there are things you can do to prepare, and there are things you should do to ease the pain and to be able to take precautions ahead of time, so that effectively, if the worst happens and it doesn't hit so badly, it's the people who are looking the other way and get steamrolled because suddenly interest rates are up and they've got these huge debts and nowhere to run. It'll be too late then for them, won't it, in terms of trying to actually deal with it. So, in a way, if people have been following what we've been saying over the weeks and months as we've been talking on this channel, we're just trying to alert people to think more broadly and don't just take the mainstream story as being gospel truth. There is an important set of deeper issues here which potentially need to be navigated, and that's, I guess, what this show's all about.
Yeah, absolutely. And I guess a takeaway is, even though the bank gave you that loan, or they gave you the finance on that Q5, not in the colour of your choice, obviously. People need to sit down with their partner and stress test themselves at a 6% mortgage repayment on an asset that has the potential to drop 30 to 50%. And let's tick it off again. That's the equivalent of being sandpapered to death. I'm worried about my future. I'm worried about where interest rates will take me. I'm worried about my income drying up once speculation subsides a bit. It doesn't matter what financial position you're in. You can never really feel comfortable, because those that tend to have a lot of money want a lot more money, and they're chasing that higher high. But every new Ferrari they buy or new property, they're not getting that satisfaction. So those high income earners, which probably owe a shitload of money to the ATO, that are trying to buy more properties, are probably in a more precarious position than those that have actually accumulated and saved and have borrowed conservatively. So I think it's a time where no one's really comfortable at all, but, we can take steps. And, now it's starting to get at the pointy end where, potentially my heart's going to break for what we're about to see. And we've got all these images with what's happening in the Ukraine and with the pandemic and the homelessness, which I think is going to spread. So, let's find a big positive. But, the positive takeaway is that viewers on this channel, I'd say, are really well financially educated. You provide a great service. I just come on here to have a bit of fun, but to tell it how it is, to tell what I'm feeling, what I'm seeing, and I'm using a well-researched form guide to say that this is all going to turn to shit. I admit the last run on the housing market caught me by surprise, but it's proof that FOMO and stupid money can go a lot longer than what you think.
And that is the point. Of course, timing is always hard to predict, but the fundamentals are there. But, if we've been able to underscore that, think about the debt that you've got and think about whether it's manageable in a slightly adverse scenario. And I guess the other part of it is, don't just automatically assume that you can solve the problem by grabbing more debt, because actually debt on debt on debt is part of the problem. And the final point I'd make, Tony, and I see this all the time, that we definitely got a bifurcation. There's a small proportion of the population doing great. They're sitting on this pool of money and all these assets, but there's a larger pool that is actually really up against it at the moment. And I worry that a lot of the conversation through this election cycle seems to be biased towards that top end rather than actually the real, the real mums and dads, the real people who are actually dealing with all the issues we're touching on here. So I hope that there's going to be more reality and more focus on the people who are actually up against it, because actually there are a lot of people who are finding it very difficult even now. And as we've been saying, ahead it's probably going to get more bumpy rather than less, at least in the short term. So, Tony, I want to say thank you very much. You filled your bingo card perfectly. I've got the full card once again, so well done. And I know people have been playing along, which which is good. But look, the messages I think are really, really important here. And, as we come to the end of the show, I think the point about communicating with each other and talking about your financial situations is actually pretty important, particularly in a relationship. But also just think, the answer is not necessarily more debt. For me, that's probably the most important takeaway at the moment, particularly where we are in the cycle.
Yeah, absolutely. And no, it's been an absolute pleasure, as it always is, Martin. And I hope people have taken away something of value.
Yeah, well, I'm sure they have, and the comments have been great. So thank you very much, Tony. I appreciate that. We'll do it all again down the track and see where we are then. Who knows where that will be, but I look forward to that. But I'll take you offline now and then finish the show. See you later. Cheers.
Good night.
So there you go, folks. Very interesting conversation with Tony. Very, very much to the point, and I hope that was useful. So just closing out the show tonight, that to say that next week I'll have... that's Tony. We've had him. We want Damien Klassen. So Damien Klassen is on next week on the 26th, And we'll be, again, talking about particularly the investing situation and what's happened to the markets. Of course, a lot from last week and last month to talk about. So that'll be an interesting show. So mark your diaries and join me again next week for a chat with Damien. And I want to say thank you very much for spending your Tuesday evening with me. And I hope you have a very good evening. And just to say that the dogs are back. They actually got very upset with all of the thunder and the lightning and the rain, but they're now back and asleep. So there you go. The final doggy cam. Oh, Meteor's just heard a thunder clap. So that was why the dog woke and looked up. She doesn't like the thunder much. Anyway, with that, I'll say thank you very much. Have a good evening. See you again next time. This is Martin North from Digital Finance Analytics, signing off. See you later.